Welcome to another episode of Founders Club. Today I'm going to be interviewing Ted Prisbalek, better known as Rancho Ted. He is the founder of Rancho Ted Hardmoney Loans and has done over 1,000 hard money and private money deals over his career. We're going to be breaking down everything you need to know about hard money loans, from how to qualify, what the terms are, the money down, the rates, and everything in between. Exactly what to do when you come across a great real estate deal, and how you can use hard money loans in your real estate business to make massive profits. If you have any questions, put them in the box down below. Make sure you judo chop that like button so other people just like you can find this video. And as always, if you like money and you like real estate, hit that subscribe button because this is the show for you. We'll see you on the inside. Welcome to Founders Club, the show for real estate entrepreneurs. All right, very excited to be sitting here today with hard money lender Rancho Ted.
Yes.
Thank you very much for coming out today. The reason that I wanted to have you come on and that I'm really excited to talk to you is because I think there's a big opportunity for real estate professionals out there to capitalize on doing more deals themselves by leveraging hard money. So I just kind of want to go through everything A to Z on how to do it, how to qualify, terms, all that kind of stuff, and we can break it down. But why don't we just start at the very basic, and then we can go a lot deeper. What is hard money?
Hard money is a loan you get when other banks won't do it. So it's short-term loans that are either the money comes from private investors or funds. And it's basically done on equity, not credit, not income. Loan to value is the key to every deal. And pretty much you can do any type of real estate as long as there's equity in the property.
So, okay, perfect. I like that. So why don't we go through some examples of when people would want to use a hard money loan?
Sure. Well, let's just say it's a purchase on a real single family residence, mortgage broker. I used to be a mortgage broker, so God bless all you mortgage brokers. Right at the end, the underwriter says, hey, we're not going to do this because of some stupid reason. And the next thing you know, you've got to close in a week. Well, the private money can actually step in and close a loan, and they've closed loans in 3 days. So I can save the deal because this property is so important to that person. You know, you may pay a little extra, but it saves the property. And then whatever problem they had, they can get it resolved in a month or 2 months, and then they can get a conventional loan. So basically what private money is, we're situational lenders, and we're the solution for it.
Okay. And I want to get into all of that kind of stuff. So hard money would be used in, obviously, like home flippers love hard money.
It's right up there, yeah.
Right. And so we can kind of break down some more of those examples. I think one of the big things out there that people are afraid of. So I want to kind of go through the pros and cons of hard money. Obviously, like, let's talk about the pros first. They can close fast.
Yep, that's
right.
One of the more important things. We're the last lender they go to, so we run out of time. And normally 14 days is a nice number. That is easy for us. But I've done them in 3 days or 4 days, whatever you need. So that's one of the beauties of it. The other thing is, you know, it's I think I was telling you a little bit earlier, it's common sense. And documentation wise, it's not all these statements you need. It's really, again, on the loan to value. So if that's there, that's the bottom line when you're lending.
So what kind of, let's keep going on the pros, right?
Sure.
So obviously, fast, right?
Fast.
If you want money to do a deal fast, it's all cash. Let's talk about it's much easier to qualify than a traditional loan. So talk to me about that.
Right. Now, there's a lot of people, obviously, that are self-employed, so they don't qualify with their income. So we may get the taxes, but it's not like we'll need them. And that's a huge plus because of, the ratios and all that. We know they make money, and now they don't go through this battle trying to prove their income with us. And, credit wise, one of the pros is we don't really need credit. If you're from another country, if you don't have a credit report, that's fine. And if you don't have income, that's fine. We'll still do the loan. So you can have credit issues, maybe from a divorce, and somebody didn't pay the bills. Your FICO is 550. It makes sense. Yeah, I understand why those credit scores are low. So, you get around all this stuff that conventional lending won't do. So it makes it a positive thing that you can get a loan without all that information.
So self-employed people you mentioned, low or no credit people, people from out of the country,
Yeah,
these can all qualify for hard money loans because it's strictly based off the asset.
correct.
Right. And another one I think, which is big for us, and I think where a lot of people leave money on the table in the real estate business, and we were kind of talking about this a little bit before,
Yeah,
is we have a lot of realtors that come to us with deals, and they'll kind of they're the first ones to find out these good
yeah,
deals sometimes,
yeah,
and a lot of times they'll farm them out to investors,
yeah,
which is great because you can get double commissions and things like that, and you don't have to do the work. But there's also big opportunities when you come across a good deal to actually do it yourself.
yeah,
And one that just comes to mind the other day was one of our agents came to us. The properties in this neighborhood all day sell from 1.2 to 1.4 million. He could have got the property under contract for about 850, 900.
yeah,
And he was just, I was like, why don't you take this deal down and do it yourself? There's a lot of meat on the bone, and this could be a great first deal for you.
yeah,
And he was just scared to do it because he didn't have the money. And I tried to kind of talk to him about the hard money loans and how to take advantage of those. But what would you say in a situation like that?
yeah. It's funny. I had a realtor call me yesterday, and he had a deal, and I said, you realtors got it made. I said, you guys see these deals, and you can go buy them yourself.
Mm-hmm.
And I've had over the past people like, I'm done giving it to investors. I'm going to start doing it myself. So yeah, as a realtor, my God, you can make so much money off these flips because you're the first one. So, it's unbelievable how the hard money world has changed as far as like flipping goes. There still is a program where you can put 10% down. So you buy something for 500,000, you come in with 50, and closing costs. So let's just round it up to 65,000. They'll give you 100% of the construction. And at the time, you didn't need any experience, and your FICO had to be 660. I mean, it was so easy to do it yourself, and you could borrow it from a friend. And guys go 30-30. It's like you do it all over the place. So they've made it so easy to do flips and inexpensive. I just think a lot of realtors don't realize that they could do it, and they need to get educated.
So we're definitely going to dive a little deeper on that, like once someone finds a deal, what to do next and the whole process and all that. But real quick, why don't we talk about the cons of hard money loans? Obviously, the pros are fast, all cash, no, very little qualifications, just based on deals and equity and purchase price and all of that. So what about the cons? What are some of the downsides of?
Yeah, sometimes you do these bridge loans, and we did one where they bought a property up in Montana, and they had a free and clear property, and they took $1 million out, and they used cash to pay for that property, and then they couldn't sell the property that they took the million out on, and somebody had given them some bad advice on the value of it, where they thought it was like worth 3 million, and the next thing you know, you're down to 1.8, and it became real stressful, the payments and all that. So that's a little risky right now in this market, right? Because we don't know where values are going, and they're not selling as quickly. This was before the market went crazy. Then the market went crazy, you could sell it in a week, right?
Right.
And now you're back to where somewhat normalcy in that. So the risk of that, particularly bridge loans, Fortunately, I do a lot of good loans. And I don't really run into a lot of problems. So I'm grateful on that. But, those payments, it's still not too bad. The payments are interest only. So, I hate to say it, but there's not a lot of that.
So yeah, I feel you on that. I think the number one thing that I hear is that it's expensive. Right.
Yeah,
So let's talk about that.
that's a great topic. I used to be a mortgage broker, and there was nothing better than saying no points and no fees.
Yeah.
When you go to the private money world, you can't get away with that because in the conventional world, you can raise the rate and put the cost in the rate. In the private money world, you can't. So you have to pay it up front. And that's where people like, oh my God, you're killing me. But back in the day, it was really bad. It used to be 6 to 8 points. Then it went to 4 to 6 points. Then it went to 2 to 4 points. And now we're basically at 1 to 2,
Okay.
depending on the loan size. So it's not that expensive. And it's basically what you would be paying with a mortgage company, but we can't put it into the rate. So you have to, pay 1.5 points. And if it's $750,000 loan, it's going to cost you 10 grand plus the title escrow, $15,000. And yeah, so that's the downside.
So the price, obviously it is expensive money, but the reason that that's okay in most cases is because if you're flipping, let's say you price that into the cost of the flip,
Yeah.
and you would lower your offer price by that amount to cover it.
Right.
And then also the other benefits of no qualifications, no credit checks, no income verifications, none of that.
The other thing that helps is the payments are interest only. So if you get 9%, it's not principal and interest, it's interest only. So that helps you with the cash flow. And that's, again, every bit 9%, we're almost at that, on these non-QM loans, and then 6.5, I think, on conventional. So in the big picture right now, private money is not that expensive on the rate anymore.
Yeah, and do you see that changing?
No.
No.
The reason why is I got more investors I know what to do with. I've got people always calling me up. Hey, you got any loans? And so there's so much competition. The 8% I think are pretty much done. But 8.5, 9% seems to be the magic number. So 9%, and I don't know, we'll see where the market goes if the rates keep going up, but 9%, which is kind of was in the ballpark the last 10 years. So
okay,
it's not really
so
changed
it's been
much.
pretty steady.
Pretty steady, yeah.
And then what about how does experienced investors versus newbie investors factor in? Like, are newbies paying more than experienced investors, and kind of what does that look like?
Do you mean investors as people lending the money or investors as flippers?
Yes, the people borrowing the money to either flip or do whatever they're doing with it.
Right. Well, it's getting a little more challenging because because the market's dropped. Some of these funds are cutting back on these 10% downs. They want more. They want a little bit of experience. For example, that 10% deal used to be no experience, FICO 660. That was the bottom line. So once the things started changing here in March and April, next thing you know, the FICO went to 680, and they wanted one flip. Which, I mean, in the big picture is nothing, right? And now it's if it's 720, one experience, and you need to put it in a some type of entity, so you can't buy it in your name, which is no big deal. You can get that done. Bottom line is it hasn't really changed much. There's just concern, and it should be concern for the investor, right? If the values keep dropping, you're going to get stuck and not making any money, and owning, so you may do all this work and make no money at all. So it's really got to be careful.
And when you're saying investors, you're talking about the people that are giving you the cash to lend out, because if the person doesn't pay or it sells for a lot less, they either lose money or will have to foreclose on the property and go through that headache.
Right. So it's kind of both. So the borrower, the person looking to do the flip, obviously needs to be careful now, because you don't want to get trapped in a property that's going to be coming down. You can't sell it, and next thing you lose your whatever down payment you had, and could lose 50 to 100,000. And the investor, he's nervous. because if values do drop, he may get something that he thought he had 70% loan to value, and now he's only got now he's at 90% loan to value and barely enough room to get all his money back and his interest. So it's a little tricky. So everybody needs to be careful.
Yeah. So what advice would you give in that sort of a scenario? Just
Well, if it's an investor, we certainly want to try to get to 65% after repair value. And then for the guy, the borrower, investor, they just have to do their homework, man. They just need to make sure. We all do our homework. So the investor will also all look at this deal and make sure this thing is looking like the correct after repair value, so nobody gets hurt.
Yeah.
So we're all working together, I guess, to make sure.
And that's actually a really great point about the all working together piece, because I think that the great part about working with a hard money lender is they're almost like blessing your deal to make sure it's a good deal before you do it.
That's a beautiful thing you just said. So we were just talking about realtors who are nervous about doing the first thing. And that's the one thing everybody's making sure that it is correct, because they're not going to lend to it.
Right.
So that's
so essentially you've got what you think is a good deal. You take it to your hard money lender, and if they say no, you know that it's probably not that safe of a deal for you to do. And whereas if they are willing to lend on it, it's like a second blessing, both by your underwriting team and the investor's underwriting team.
Right. So if you're a beginner, that's beautiful. But there may be some really experienced borrowers, investors, but they know more than you do. They know the area, they know more than the lender. And so those guys just get experience. So one way or the other, they'll make it work because they know, that this will sell for this, where we don't know because they know the area. Right. So this experience comes into play there. And so a lot of times what helps is if you work with a particular borrower, you get to trust them, that trust factor, they've done 5-10 flips, that they know what they're doing. If something goes wrong, that they'll do whatever it takes to make sure everybody comes out
right
good. So experience certainly helps.
Okay. So let's break down the terms of a hard money loan.
Sure.
Someone calls you, what happens?
All right. So everybody doesn't want a prepayment. So, and then there are tons of investors that will work with that. The one I was talking about with 10% down, they do their loan for 12 months, no minimum interest, so they can pay it off in the first 2 weeks. The rates were ranging from like 7.5 to 8.5. Obviously, that's gone up, and now we're 8.5 to 9.5. So that's the term is roughly 12 months. Now, there are private investors that will work with no prepays, and then there are some that want a minimum of 3 months, which is no big deal sometimes because the person knows it's going to take at least 6 months to sell this thing. So you can put three months minimum. The terms can start; they are changing really. They're more going towards 9.5%. And then one thing a couple things I want to point out, and one of the best ways, in this particular investor who called me yesterday, he had a property that was free and clear. So you can put no money down and cross it with a property with a lot of equity. So just an example, he had a property that was worth 600 free and clear. He was buying one for 700. We just crossed it and he came in with no money at all. And that's great. That makes it easy,
Yeah.
So
I want to break that down a little further in some of the examples that I want to go through with you. But sticking on the terms, so you said 10% down?
If you're using it,
really low.
it is, and you can do it. If you FICO 720, you can get away with 10% down.
And that's like a standard loan, or that's a
no.
Money loan?
It's not it's a fund that's real aggressive on flips.
Okay.
They'll do 10% down. Go to a private investor, and let me go there's also funds that do 15%. So 10 to 15 is definitely doable.
Okay.
When you start using private investors, if you have no experience with the bar, the private investor says, hey, 20% down. 20% down, and they want the after repair value 70%, and in this market probably 65%.
So walk me through like an example of what 10% of what down. So let's say it's for even numbers sake, let's say it's $1 million deal.
Right. So 10% would be 100,000
on the money borrowed or on the after repaired value.
On the money borrowed.
Okay.
On the purchase price.
Okay. So
they give you a 10. So you put down 10%. Okay, gets a little complicated here, but 10% down. But it's going to be $70,000 in work, right? So what they do is find out what the after repair value will be when you're finished. So they will give you up. And this particular one was doing 75%. That's why, well, you realtors, man, you could have made a fortune, and that'll come back. So let's say the after repair value is 1.2. Okay. Well, they will go 75% of 1.2, whatever that number is. For the loan amount. So they give you all that, and anything else, you need to come in.
Okay.
But they certainly want you 10% because they want you to have some skin in the game. But they will give you all the construction costs, and they do fund control that.
Okay.
That's important to know.
Can you explain what that means for the people that don't know?
Yeah. So one thing about an investor, they want to make sure that the work gets done. So they just give you a certain portion of the money, and then you do the work. Then you have to show that the work's been done by, they'll have somebody come out and look at it. And then you can show them the receipts of what you paid for. And then when they're comfortable with everything, then they give you the next batch of money.
So it comes out in tranches. You don't get all the money up front.
That's correct.
So does that mean that you have to pay the contractors out of your own pocket and or find contractors that are willing to get delayed payment?
Good question there too. Everybody's a little bit different on that, but I know that the contractors certainly like to get paid as the as progress goes. So you can actually get that part of the tranche.
So what do you mean? You would front them with your own cash and get paid back? Or
no, you put it as part of the. You kind of go both ways with that, depending on who the investor is. So with the 10% down, I not quite sure on how some of these will work on with paying the GC.
Mm.
So, and sometimes a lot of these people have experience, so they don't have a GC; they just do it themselves.
Got it. So just to kind of follow through on that. So you get, let's say, in that example, let's say whatever, you get $100,000 for repairs.
Yeah.
You're not getting that 100,000 at once. Let's say you do, the electrical first, and that's 15,000.
Yeah.
They come inspect it all, make sure everything looks good. Then they give you the 15,000.
Correct.
And then you can do the next part of the job.
Correct.
Okay.
But there are some times where they give you the money up front and then you do the work. And it's vice versa. You throw the first 15 in and then they'll reimburse you.
Okay.
And then they give you 15 back and you use the 15 again.
Got it. So you can just roll the money. Yeah,
you just keep rolling it. I've had it where, I've lent the guy money and he actually never did the work. So it's important actually, as an investor to have the borrower actually come in with the money first so that you don't have that issue. And live and learn, man.
Okay. Yeah, that would be bad.
Yeah.
So for terms wise, you're talking 10 on the low end to 25% down.
10
to 20% down.
Yeah.
On purchase price. What else is there? Is there points up front? Is there?
Yeah. So, it's a very competitive market on flips. So, the points are 1 to 2. I think everybody tries to get 1.5.
Okay.
It's paid up in front, but so it'll be down payment plus loan costs.
Okay.
And then fund control the construction.
So the upfront is the down payment plus any origination fees or whatever you
Correct.
want to call them.
Yeah.
Prepayment penalty, I'm hearing, is as low as 3 months and as high as a year.
Well, there's no prepayment at all.
Okay, so some loans even have zero.
Some
prepayment.
have 3, some have 6. And really, you try to work with the borrower. You know, you want to make it a win-win for everybody.
Right.
So if the borrower says, "Hey, man," if you're using a private investor, borrower says, take at least 6 months. I says, "All right, well, we'll do a 6-month minimum, just as long as you feel that you're going to take longer than that." They're like, "Yeah, no problem." But some are saying, "Hey, I can get this done in 2 months." Well, then I said, let's just not do a prepay, and we'll just adjust the fees to make it work for everyone.
And I think back to like pros and cons, I think that that's another really big one is that you're working directly with the person that's giving you the money for the most part.
Yeah.
And so they're able to custom tailor the loans, maybe we'll tweak this a little bit. Whereas if you're going through a bank, you got to go through 10 layers of people just to make any adjustments.
It's important because every deal is different in the private money world. So you got to be flexible on that to make it, again, a win-win for both sides.
Yeah, that's one thing I keep hearing is that it's customizable and flexible.
Yeah,
which
it's a beautiful thing.
Which is a very beautiful thing. What about other fees? Any junk fees, processing fees, this fee, the other fee?
Well, one thing we like to do is just make sure all the documents are correct. So we use a company called Jurassic to draw our loan docs. So they underwrite the loan docs to make sure all the LLCs are correct. Trust is in a trust. So everything's done to make sure we're compliant on everything, which is nice. So that costs around $800 and then a $14.95 processing fee.
$14.95. Okay.
Yeah, it's kind of standard.
So that's what, like $2,300 plus the points, plus the down payment.
Yeah.
Anything else I'm missing on upfront costs?
Yeah, sometimes you get appraisals. Every deal's a little different on that because you could be in an area that's kind of, I don't know. Some are easy to do. So you can say no appraisal, then you. So that's it's $600, whatever it is, depending on the size of the property.
Cool. Now let's talk about documentation. You mentioned all the documentation, making sure all the I's are dotted and T's are crossed.
Budget is the biggest one there.
Budget. Okay. So what is required on your end from someone who wants to borrow the money in terms of documentation?
Well, loan application obviously is number one. We do run credit on everybody if they're from the country, right? We certainly like to see where the money's coming from, if it's their money. But in the private money world, it could be from anybody, it could be from anybody. So, but that, as an investor, if it's their money, you feel better about it. If it's their brother's money, you feel good about it. But if it comes from some other investors that are, then it still is concern. But if you had a good loan to value, there is no concern. But sometimes you get people who have equity partners, but they're not really good friends. And then that's where I told you the guy ended up taking the fund control money on the first draw. Long story there, but it wasn't people he knew, it was like investors. So that's where you have to be leery, but we did end up getting clean out of that deal, but it took a while because of all the problems that came with it. But so bottom line is where the money comes from. It's important, right?
Okay.
And then if you have a trust, we need a whole copy of the trust. You have an LLC, you got to make sure that's up to date because the attorneys will review that stuff.
Okay.
Beside the old driver's license, stuff like that, that's about it.
Okay. So not a lot. Purchase contract, entity, whatever it is, whether it's an LLC or
title report, right?
Title report.
Yeah.
You said obviously seasoning on the money, where it comes from, but you don't really care.
It's not seasoning, no.
Okay, it's just
it's your mother gave you some money. It's in your car. It doesn't have to be seasoned.
Okay.
again, equity is the key to this whole thing. So whoever's lending that money better make sure it's, because we'll be okay because we'll be protected by the equity.
Mm-hmm. Right.
But it still makes it nice to know that it's their money, or it's a relative's money, or it's a friend's money. But again, it's not that important. Equity and the property is the most important part.
Yeah. Getting the good deal is the main thing. And then you said you run credit, even though I heard you say earlier that credit doesn't really matter.
Right.
So what does that affect, if anything?
Well, let's say with these funds, they now have changed their criteria. So it was 640, it went to 660, 680. So it goes up. So they do care.
Okay.
If you use private investors, that's another animal.
Got it.
They do look at it, and they look at the overall picture. And like I said, if somebody's got bad credit and there's a good reason for it, well, that makes sense. That's why they have bad credit. So it's no big deal. Now, you have investors like, for example, I've got one with a 430 FICO.
Wow.
I think it's as low as I've seen.
Yeah.
This investor, they're putting down 30%. It's just a straight up purchase. He's not afraid to take the property back if he has to. Where you have other investors like, I don't want any part of foreclosing on anybody. I'm out of here.
Yeah.
But you have people like, the purchase price is like $700,000. I mean, they're putting down $200,000. That's a lot of money for somebody who doesn't have a lot of money. So the odds are with you that they're going to make those payments.
Right.
It's supposed to be an investment property, so they'll have investors. So you should be okay. Too much money to lose. So if things go south, they can sell the property or whatever they got to do to make sure they don't lose their money. So investors are pretty comfortable. But if it does go south and they realize the credit's 430, they're not afraid to foreclose and take the property.
Right.
But always remember, the investor doesn't get the property; it goes to auction. So then it's not like he's getting the property; it goes to auction, and then if nobody buys it at the auction, then he does.
Mm-hmm.
So,
yeah. Sounds like a pain for them to do. But like you said, some people are just going to turn it down. They don't want anything to do with a deal like that. And some people that are providing the private money are not going to be scared of that and will take that
right.
deal all day.
And that's one of the beauties of having private individuals. They're all different.
Yeah.
They all have certain things that they like. They don't like certain areas. If it's in a bad area, they'll do it all day. If there's some, they'll never touch it.
Yeah.
If they'll only do the ocean. So it's kind of nice to have a lot of options because there are a lot of situations.
Yeah, one thing that I'm noticing that I wasn't really so much aware of before is that it sounds like when someone contacts a hard money lender like yourself, you have options whether you're taking that to like a fund, like a big money bank, let's call it, that is just looking for this type of deal. Or you have people that are just the mom and pop types that have the cash that are going to be require a little bit more money down, but maybe a little bit looser with everything else.
It's just a lot easier. I mean, when you go a fund, it's still it's not a bank, but it's still not an individual. Individuals like, hey, don't worry about it, or so they definitely have a pros and cons on both sides of a fund and a person. But you can get things a lot done with an individual than probably the fastest way.
Yeah, that's very cool. Anything else on the terms? I mean, we've kind of covered rates, down payment, fees, documentation.
No, just I have a couple of sources now. But again, I know. Yeah, I'm done on that part.
Okay.
But I just want to make sure that these get covered. And one is I have a source for an equity line. Hard money equity line that if you have
I want to get to that in a minute because I saw that on your social, which I thought was really cool.
Yeah, it's really cool. And then the only other thing is crossing other properties.
Is what?
Crossing other properties to make, like I said, by getting a flip, you have a free and clear property. Just cross it. You come in with no money. You want to get it done, and
Yeah, that was another thing that I thought was really interesting is leveraging other real estate that
Yeah.
someone might own.
Yeah.
And there's a couple scenarios that I think that could be really great for. So before we get to that, uh, I just want to fully understand what a borrower is paying out of pocket and what is baked into the deal. It
Right.
sounds like down payment,
Closing
fees that
costs.
we talked about
That's it.
are up front, and the
Yeah.
points up
Yeah.
front is
Yeah.
what they're paying up front.
Yep.
And then when they're ready to get out of the deal, let's use two examples. They want to keep it or they want to flip it.
Yeah.
How are you getting transitioned out?
Basically by the new loan. So, most people seem to flip it. Had been flipping it because the values are going up so nicely.
Right.
Not sure what's going to happen now. If people are just going to try to keep them for a while and rent them out.
Yeah.
Either way, you can't go wrong.
Yeah. I think both scenarios,
Yeah.
it's just a different type of person.
Yeah.
Right? A home flipper, it's real simple. They sell the property, you get paid, they get paid.
Yeah.
Deal's over.
Yeah.
A scenario like you mentioned before where someone might have another property that they want to leverage against. Maybe they just want to leverage that to get into the deal, and then they would just refinance you out, you get paid out, and then they go into like a regular 30-year type
whatever
loan.
it is. Yeah.
Okay, cool. So let's go through a couple examples. I think that this is going to be really good and really interesting because we've kind of covered a bunch of them. And I want to just start with the house flipping example. Let's just walk through a deal. So once someone finds a good deal, let's walk through the process from A to Z.
Sure. I just got a call yesterday. Purchase price, let's just use 600.
Mm-hmm.
He said, Ted, can we do it? I said, well, you tell me how much money you get to put down. He says, well, we use that other property. I said, I don't have, so I can't use that other property because I haven't refied it yet. So I said, okay, well, let's try 10% down. I got my processor in the line. We did a 3-way call talking about, with this particular fund. He said that his FICO was 695. Turns out now that they pushed it to 720 on the 10% down. I said, well, look, it looks like we got to do 15. He says, that won't be a problem. I've got other people I'm going to do this with, so 15% down. I said, great. So we're moving forward. So send out the loan application. And this particular one, it's really not a loan app. It's just a form with the history, and it's pretty easy. But let's say it was a private person that was going to do it, not a fund. You send out the loan application, and then the next important thing is really them doing their due diligence to figure out exactly what needs to be fixed. So then they come back to us with a budget. Hey, Ted, we're going to need this for painting, carpet. When it's a deal where there's no major construction, like they're not going to add a bathroom or a room, it's just carpet, just basic stuff. Those deals are pretty easy, because there's not a lot of work going to be going on. So 50,000,
right?
Piece of cake, right? So we're not too concerned about the budget as much as we would be if they were going to add another room or rip out bathrooms and start making this thing into a huge project.
Okay, so in that example you just gave, the $600,000 home, let's say that's the after repaired value.
No, it's a purchase price.
Okay, let's say that's the purchase price. What's the after repaired value on that?
Well, it needs to be, if it was the fund, whatever.
Let's not use the fund. Let's use traditional private.
70% would be the number. So whatever, let's just do it. 600,000, 10% 60, 20% is 120. So 120 down, loan amount 480. Okay, they need 50,000. So they can come in with the 50 or we give them the 50. So let's go to 530.
Okay.
So whatever, is it 800, 750 would be 70%.
Okay.
Of that. So now they want it to be that too, because they wouldn't be doing it. There's no money to be made.
Yeah, of course. Yeah.
So, right.
Course.
So we're all on the same page here. We certainly want that value to come in. Otherwise, you're doing all this for make a little money.
So in that scenario, let's say after repaired values 850, they're coming in with 120 down
plus closing costs. So
plus closing costs. So let's say 135 down.
Yeah.
The 135 is now that can also be, that doesn't have to be their money. That can be, they can go with a partner. They can do whatever they got to do to get that money. And you don't care about that.
Exactly right. So they work with their friends, family member. Hey, let's do this together.
Yeah.
And we'll split it.
Yeah. Because I think a lot of people are like, oh man, 135,000. Like I don't have 135,000, but they don't necessarily have to have the 100.
And you have a ton of, you probably have a ton of friends who want to be investors. They don't know what they're doing, but, so everybody's afraid to do it and they don't realize that it's really not that hard.
Mm-hmm.
They're all over the board, the realtors, because and I'll say again, most realtors, most mortgage brokers have never done one. They don't understand that. And so nobody's educating them. I try to do these lunch and learns to help people understand how it works. But again, until they learn how to do it, you're missing out on these opportunities. And that's probably good why we're doing this.
Yeah, exactly. Because I do think that people leave a lot of money on the table, especially realtors when they come across these types of deals, or even like investors that are, wholesalers. They're good at finding deals and then they just flip them to someone else. But it's like, why not take that deal and do it yourself?
Correct.
So that going back to that one flip deal for a second,
sure.
850 after repaired value, they're coming in with the 135 down. They're getting a loan amount for
it would be 465, 600, 135 down, 465, but then we give them 50.
And then you give them 50.
Right. Or whatever that number would be.
Mm-hmm.
You fund control it. Sometimes you don't fund control it. If you've got some history with the person, you trust them. At a certain point of trust you have to have, otherwise you'd never get deals done. We wouldn't sleep at night. So we have a certain trust, and sometimes just say, just take the 50 and go do it.
Yeah. So they get your loan. They're able to use that plus the down to buy the property. They, let's say, have a 90 to 120 day target for completing their renovations. They've fund controlled or not fund controlled the money for the flip.
Yeah.
So that comes out. They get that. They do all the renovations. Now it's on the market, let's say for 850. Let's say it sells for 825.
Yeah.
Now your money comes out off the top. So the loan amount gets paid back plus the construction costs.
Yep.
And then the investor, flipper, borrower is left with the rest.
Right. And as a realtor, you can sell your own property, so you don't have to stop paying all the realtor fees. So you save money there too, right?
Which is another huge benefit. Other investors are, they're paying 5%.
Yeah.
For the buy and the sell. Some, if they do volume, maybe less than that, but it's still substantial if you can do it yourself.
Yep.
To save that extra money.
Yep.
Cool. All right, now I want to go through the other example, which you mentioned earlier, which was the hard money line of credit.
Yeah.
So in this situation, someone would need another property that has equity in it.
Correct.
And then talk to me about how that works.
Sure. Well, I had a borrower who inherited a property from his parents. He passed away. It was $2 million in Solana Beach. And he was a flipper. And I said, well, why don't you just do an equity line? You won't have to keep getting loans. So he got $1 million line. And on these equity lines, they'll go to 60%.
Okay.
So that's the max. And the loan is at 9.5% roughly. And there's no prepayment penalty. And the cost is like 3 to 4 points. So it's a little more expensive, but you don't have to keep using it.
Yeah.
So you don't have to get another loan. So So he can go buy a property for 800 and just give him cash.
Wow.
And then still have 200 to fix it up.
Wow.
And then go sell it and then pay it off. And so it's a beautiful thing. I keep telling everybody, I don't see as many people using it as I thought people should. Everybody's got equity in their property right now. So, I'd get the line and just have it there when you need it. And
is there a minimum amount on that or maximum amount? Or just 50%, 60%?
60% of the value of the property. So the minimum the investor will do is 250,
Okay.
and they'll go up to 10 million.
Wow.
So it's a fantastic tool.
Yeah.
I think. And again, I tell people, but they wait till the last minute. Oh, you didn't do it now.
Yeah.
But they can turn it around in 2 weeks, an equity line. So
That's great.
yeah.
All right. Another example that I think is really relevant for real estate agents is people that have a property and they want to move, but they have to sell their current property to buy the new one.
Right.
But most sellers don't want to sell their property to someone that has to sell another property first.
Contingencies.
Right. So talk to me about how they can educate their clients on using hard money to make that transition faster, easier, and not have those contingencies involved.
I just had a call on my way up here on one like that. On this one, there wasn't enough equity, but to put it like a simple deal, you have somebody who has a property worth 1.5 million, and they own it free and clear, or a very small loan. But let's just use free and clear. They want to buy a property. They're going to be downsizing, so they're going to buy a property for 1.2 or 1.1, whatever it is. And all you have to do is add both properties together. So you take the 1.5, the 1.2, you get 2.7, and then you lend them the whole entire amount, 1.2. So they come in with no money down. You have both properties crossed. So you've got the investor has 2.7 in real estate or in that range, and they're at below, roughly 50%, right? 2.4. Yeah. It's a safe deal for an investor.
Yeah.
Then you go and sell your property and you get your 1.5 and you just pay it off at 1.2. So
that's great.
Yeah.
And then they also become a cash buyer on the new purchase.
Correct.
Right. So
yeah.
That has an added advantage.
That's a huge advantage. Right. Then, well said there.
Yeah. They can come in with cash. And then, so just to take this all the way through, a client, they have a house, it's worth 1.5 million. And this works for any property amount. You can just scale down or up, but it's worth 1.5 million. They're downsizing to $1.2 million.
Right.
So 2.7 is the total value of all the real estate.
Yeah.
You'll lend up to 50% of that.
Actually, 60 or 75.
60 or 75, even better.
Yeah.
So more than enough to cover the new purchase of 1.2.
Yeah.
They take that 1.2 in cash. They're now a cash buyer. Maybe they can even get a better deal on the new place now.
Yeah.
Then they have that. They're in the new property. Then they can take their time to sell the other property. Right. And all they have to do is make the interest-only payments in the meantime.
Right. But the risk there is making sure they can sell the other property, right? So, and before it was so darn easy, and now it's not as easy, but things are selling, so it shouldn't be a big deal if they, they got a good realtor in there.
Yeah, and maybe they got to sell it for a little bit less to move it.
Whatever it is.
Yeah. But they still are safe because they still have a couple $100,000 cushion there.
Right. So the rates on this stuff is around, I'll just say 9%. Let's just go 8.999%. And the cost is between 1 and 2 points. So it still costs money, but you have no other option, right? You either sell your property, you go on. Yeah. So it is what it is. So it gets a little expensive, and that can be a turnoff for some people.
I think it's just having that tool on your tool belt,
an option,
right? Because obviously not everyone's going to want to do that. Maybe they don't want to pay the fees, but I can guarantee you this: if they really want that 1.5 or $1.2 million house, they're going to do it. Right.
No, and be honest, I've done it where we've crossed 4 properties.
Wow.
4 in Little Italy to make it work. Wow. They had 4 properties. But this lady, this was her dream place. So you can't, by crossing all those other properties, you can make deals work. And that's huge to do. Yeah. The other thing I want to point out, let's say you get $1 million property and you owe $400,000. And you want to buy another $1 million property. Well, you don't have the down payment. So what you can do is a second. So you can do a second behind the 400, do 300. You take that 300. and use that for the down payment on the purchase. And then we'll give you a loan for $700,000. So there's different ways to make this thing work.
Yeah.
Because you don't have a free and clear property, so you can use the money, pull it out up to a certain loan to value, and take that as your down payment
And combo it up.
Yeah, or you can get a conventional loan.
Right.
Whatever you want to do. So there's different ways to make those bridge loans work.
Yeah, that's great. And that goes back to the reason why private money, hard money is so great, is because all the customization, and there's really a million different ways you could slice and dice it.
Yeah. The first thing people do say to me is, "Hey, Ted, I got a situation." It's the first thing that comes out of their mouth.
Right.
So I used to go down to PSAR and I used to speak, and the guy running the show over there says, "Ted, you're a situational lender." He kept saying, "You're a situational lender." And I think, darn, you're right. Because the first thing they say is, "I got a situation."
Yeah.
So it's all situations that we step in and help resolve.
That's awesome.
Hopefully.
Yeah, exactly. So moving on to another one, and you did just mention it. Let's talk about bridge financing.
Yes.
Talk to me about that and kind of some options there.
Well, that's basically what we were just saying. The bridge loans are short term to buy other properties.
Okay.
Might have to get more in detail on what you're talking about as far as bridge right now.
Well, let's move on then, because I also have construction loans.
Construction.
So talk to me about construction type loans.
Be careful.
With hard money.
Be careful.
Why, let's start with that. Let's talk about being careful.
Yeah. So, one I did, and it was with a friend, and you kind of, things, you just don't know what's going to happen on these things. And they were building 4 houses, man, and everything went south. And it took 4 years. It was an absolute nightmare.
Yeah.
So I can't say I do a lot of construction.
Is that because they didn't have the permits and everything?
No. Well, no. Yeah, that was the start of it. We were told all the permits were ready, and I'm not an expert ground up construction person. So the next thing you know, we're ready to go. And then it turned out they didn't have the permits ready. It took another 3 months, and they had already taken the money. So I was paying on the money. And then they finally got it rolling, and 4 properties. And the guy had a lot of experience. I mean, this is a long story. I'm not going to get into the whole thing. But you got to do your due diligence. I mean, it turns out the guy had some kind of problem from a previous deal where they hit him with a lien that crossed all over everything. And so we get hit with his lien, which there was a property about to be sold, and that's what killed us. And they couldn't sell it because the lien created us not to be able to sell it, to bring in more cash.
Wow.
It was a disaster.
Sounds like a very sticky situation.
Very sticky. Yeah. And put it this way, I get out of the ground up construction, but I am in the ground up construction because I know people need them. So I've kind of worked with.
Let's talk about the positive side, right? Like what is a deal that you would do?
Well, I wouldn't do any ground up construction anymore.
Sorry. If someone wanted to do a construction project and they came to you for the money,
sure,
what would you be looking for?
Sure, free and clear. That's number one. You like to have the permits, all that stuff in place, and the property ready to build.
Okay.
So once that's in place, obviously you need all the plans, blah, blah, blah. It's very similar to a flip. Everything's fund controlled. And in the end, you want the value to be 70 or less, or 65, and even lower, because you have to have room in there for problems that may arise that you don't know that's going to happen.
A little buffer.
Yeah, you need that buffer, and that's pretty big. But no different than a flip, really. It's all about the borrower having skin in the game.
Okay.
And loan to value, and then you just fund control it. And again, it's no different than a flip, really. Almost the same thing.
So you said free and clear. What is free and clear?
They own the land.
The land, okay.
Right, and they owe no money against it. So right there, you have equity in the property, and then when you start putting in the permits and all the stuff that comes with that, your value goes up more, because then you can go sell that to somebody who wants to build. Right. So and then once the plans are done and you figure out what the future value will be. You know, you may have to come in with more money to make it safer, or you may not. But it really comes down to what the final product will be. But,
Okay.
And we'll keep saying this. It's all about loan to value, man.
Right.
So, you know, that's the bottom line.
Yeah. And you generally want to be in the 65 to 75.
Well, in 70 or less. I use
70 or less. Okay.
Yeah, but
Of after repair
right.
value.
But these funds that get aggressive and they allow you to go to 75, which is a beautiful thing.
Mm-hmm.
So that's good.
Okay. Yeah. So call a guy like Rancho Ted and he'll point you in the right direction, get you set up on the money side of things.
Yeah.
Okay. Couple of questions I want to wrap with. Anything else there on the use cases for hard money that we didn't cover?
Well, you know, seconds are pretty big right now, you know, and, you know, owner occupied are very challenging. I can do owner occupied loans.
Okay.
Most won't touch them. When you do seconds, the max would be like 55% on seconds. But if it's an investment property, go up to 65. What else is pretty busy out there with? Again, the old, you know, people can't close in time. You got to step in and close. You know, I just had one of those that we closed in 7 days. So I'll just keep that in mind. But obviously, if you have equity, we can do commercial loans, any type of land loans. Land loans are tough, though. Land loans are tough, man. If you do those small ones in East County, 200,000, probably not going to do it.
Yeah.
Or if you want a second for 50,000, probably not going to do it.
Yeah.
So, but the big ones are easier.
So ultimately, it sounds like it comes down to just finding the good deal, which, you know, investors are good at, realtors are good at, because they're right there on the front lines.
Yeah.
Once you find it, then you connect with a hard money lender, private money lender like Ted to get the money for the deal, and then you can do some big things.
Yeah. The other thing is I can't say enough about common sense. If it makes sense, you do it. Got bad credit, but it still makes sense, you do it.
Right.
You know, got no income, but you know, we know you have income, but we can't see it. Doesn't matter. Makes sense what you're talking about.
Right.
So it's all about common sense.
The deal makes sense.
Yeah. If it makes sense, you do it.
Yeah.
In the conventional world, you still don't do it. So I'm saying that.
Cool. What about this? What about in 60 seconds or less? What is the key to hard money, using hard money?
Well, the key to using hard money. Well, I can go back to just, you know, situations, you know, people are in situations and equity is the key to this whole thing. And the lower the loan to value, the easier it is. You can call me up and said, hey, Ted, I'm putting down 500 on $1 million. I'll say, we'll get you loan docs tomorrow.
Yeah.
It's that simple. It's just, you know, the thing I laugh, and I have some investors who like, I'm not sure. And when it's not your money, it's super easy. But, you know, I had a deal, it was $2 million to property downtown. It's commercial, mixed use, 4 units, $2 million purchase. And the guy was putting down $750,000. And I had this investor's like, yeah, I think I'm going to pass on it. And I'm thinking to myself, $750,000, you think this guy's going to walk away?
Yeah.
So I called another investor, and the first thing he says, well, he's putting down a lot of money. I said, yeah. He goes, well, that right there tells me it's a pretty good deal. Yeah. And I said the same thing, you know, but again, it's easy for me.
Right.
If I'm not using my money. Yeah. So it's that simple. If a person puts a lot of money down, they're not going anywhere.
Yeah. At the end of the day, like you said, it's all about the deal. Find a good deal, and the money part is easy.
And you realtors, oh my God, you can make a fortune here on these flips because you're on the front line. You see them. And don't be afraid. Just give us a call and put it this way. It's not like you know, like we don't report to credit bureaus, you know. So if you have a 30-day late, it doesn't get reported, that type of thing. It's not like you know. So don't be afraid. And we'll help you figure it out. So it is a good deal for everybody.
That's awesome. Yeah, and then back to the earlier point of the reason you want to work with a guy like Rancho Ted is because he's got to help bless the deal before you do it.
Yeah.
So you don't have to worry about, getting caught out or losing big time, because he'll tell you it's not a good deal.
We're all together
before you get yourself in hot water.
Right.
And realtors out there, you can go out and make a lot of extra money just by doing a couple of these a year.
Yeah. I laugh at the realtors because once they start realizing, they're like, I'm tired of letting these investors make all the money. So they start doing it. But there's realtors who aren't at that point yet, So there's like, oh, I'll just give it to this guy.
Yeah.
And then after a while, they'll say, oh, boy, what am I doing?
Yeah.
So,
well, hopefully let this be your motivation to go out there, start doing some more deals, leverage hard money, private money, all the stuff that is available out there. And as always, if you like money and you like real estate, make sure you hit that subscribe button, and we'll see you on the next one.